Hi, David. Good morning. Thanks for giving me the opportunity to talk to you about mortgages. I know that's something that you've been dealing with, private mortgages and with lending for homeowners, and where I do commercial real estate, wanting to know if you have some insights on what the commercial real estate mortgage industry is currently looking like, and if you have any thoughts on what great investments blending institutions would be interested in looking at.
Okay, well, thanks for inviting me to be part of this. I appreciate the opportunity, Mike. I know you have a great database, and I always enjoy receiving your emails. So, happy to be a part of it. I mean, there's lots of money flowing, that's for sure. Generally speaking, real estate market in general is very good. For sure, there's some segments in the commercial market that have been hit very hard by COVID, and money is not flowing much at all in those segments. Harder to get commercial money for things like retail, for example, where COVID has been, I think, somewhat disastrous by and large for the retail marketplace. Multi-residential is a very good segment. People are at home and they always need somewhere to live. So and rates are down, as you know. So I've seen lenders have been offering money on multi-unit properties, multi-residential, CMHC insured money as low as 1.5%, which is pretty awesome. There's been some new rules as far as taking money out. They don't want shareholders just replenishing their pockets. They want CMHC wants to see the money being reinvested in other multi-residential properties. So there's some restrictions around that program in particular. And industrial segment is good, generally speaking.
Yes.
And office has been hit very badly, as you know, people working at home. That's been a real upset for that part of the market. What are you seeing parallels to where the money's flowing also in terms of demand in commercial real estate? What segments do you see as in commercial real estate as being hot and not?
Yeah, I'm still seeing land, obviously, and especially in the industrial sector, being in demand. You know, we don't see an oversupply of building in the industrial sector. Still actually a shortage and very low vacancy rates. Absorption is certainly at an equilibrium. I've got buyers for properties that are single tenant, corporate type leases. Can't find enough of those. So I'm working on some out of town sites with a buyer right now who's about to make an offer on a long-term corporate lease, single tenant property. And so we're looking at what kind of returns that they'll be expecting, and the investors now are looking at 6.5 cap rate investments. So when you look at the cost of borrowing, with it being now lower than it ever has been, I was just curious to see what types of investments lenders might be looking to fund, because of the rates being, say, whatever I'm hearing, 2.5% in some cases for qualified borrowers. If you're getting a 6.5% cap rate, then you're still making a decent spread, and that's not even taking into consideration the increase in the appreciation that will happen over time with the property, which you can't really say, okay, you're getting that return now, but it's a future value on the property that has to be put into the equation. But I'm just wondering, with the rents, like you said, maybe not being there in the office sector right now, and with retail, where you're traditionally like selling things that are like shoes and clothing and objects as opposed to services. How are those rents holding up to give the returns that some of the investors have expected? And then with management costs coming into play, how does the lender look at the ability to repay the loan and just assess? But it's a big question. And then, I'm just looking at syndications, investments. I know you've done some of those mortgage investments in the past, and what kind of returns are there on those types of investments or syndications?
Okay, so first of all, with respect to commercial lending, yeah, as I mentioned earlier, you have rates starting at 1.5% if it's a large multi-residential, because that can be CMHC insured. And then, as you noted, you depending on the type of product, rates could be 2.5%, they could be 3.5%. They could be five, and a big thing that factors in is the strength of the borrower, right? I mean, if you're looking to fund a retail plaza on just a random corner owned with a lot of ma and pa tenants, small
Yep.
proprietors, good luck.
Yep.
But if it's a
Yep.
ryokan or somebody like that with deeper pockets, it's going to be looked at very differently.
Or
So,
a corporate
you know,
lease. Yep.
exactly. So, what's the ability of the actual borrower
Yep.
to service the debt? What's their net worth? What's their experience if it's a new development or land development? That always factors into it. What's their strength and what's their experience? More important than ever, if you have an asset that's not generating the cash flow, or tenants who are not paying, critical. As far as investments goes, I don't know if you
Yep.
know this, but I'm also a dealing representative
Mhm.
with an investment firm, Huxton Black. So I have some different private equity offerings that I give people. Syndicated mortgages, which I was involved with for a time, I hit into some very hard times. It was basically the Wild West here for a while, and some unfortunate stories about people who put money into different types of syndicated mortgages. The rules are very strict now as far as syndicating mortgages. I mean, if I have a husband and wife who want to invest together in a mortgage, or an individual and their company, that's something I can put together. But if you're going to actually bring together a group of investors, a lot of rules around that now in terms of what disclosures and what precautions need to be taken. So as I mentioned, I got licensed in private equity, and we have some residential REITs that are popular now because the residential space is a good one, as you know, and multi-residential. That's a great product. So we have REITs that are. They also have a preferred sort of tax treatment. They're given a return on capital as opposed to be considered like interest income, which is what you typically would have with a mortgage. People love investing in mortgages, and I do arrange some private mortgage investing for people as well. But I always find there's just never enough good product around, so that's why I got into the private equity, and the REITs are an area that are very popular and desirable right now.
So you said the money is flowing, and there are lenders for a lot of things, depending what your appetite is for risk, and for how much interest you can pay to make still a return on your investment. Um, I was wondering if you have any thoughts on uh, what things will be like, 12 months, 18 months down the road. I mean, I've seen from some conversations with people um, uh, in the real estate education system, some of the people doing masters in real estate in the U.S. predicting that we're going to see cap rates claw back, and like they're going to go down, and then they're going to go back up. So in other words, you're going to see probably the rents going down, and then the prices for property is probably going down with the cap rates going back up, and then returning after about 2 years to the rates that we have had in the past sort of year and 6 months. Um, I still think that it's really a situation where properties that are doing well and aren't really affected, like some plazas that are grocery anchored, they're not seeing as much of a change in the traffic. People are still going out. Um, and so the question I guess I have is that how are the deals going to get underwritten, and who is going to be funding those mortgages, and how are they factoring in the risk that still is out there? There's still risk. And so if I was to want to borrow $5 million, for example, who would you take that mortgage to right now? Would you go to sort of a larger, commercial lender, or even a private lender who's
Yeah.
very eager to get their money out there?
Well, as I mentioned earlier, it depends. Like every deal has different nuances, right? So the first thing is what's the product, right?
Yeah,
And
exactly.
you mentioned even in the retail space, there's variations, right? If you're anchored with a supermarket and an LCBO and a Shoppers Drug Mart, you're in good shape. If
Yeah.
you've got these ma and pa stores or restaurants who are struggling to stay alive, it's a very different scenario. Not a lot of lenders around that can, quickly write a check for $5 million. So anybody's going to be cautious. But of course, it also depends on the strength of the borrower. That's key. What's the abilities, the borrower's ability to service the debt beyond that particular property, right? Because if they're guaranteeing it and they're very well capitalized, strong borrower with a good business plan and lots of experience, that's different than Michael Davidson. I mean, you could be a multi-billionaire for all I know. I don't know. You'll have to send me your financial statements after this call,
Yeah,
but
I paid a couple $100 in taxes, $50 million.
right,
Yeah,
right.
that didn't make.
Right. So, so every deal is every a particular mortgage has to be looked at differently. But from a borrower's standpoint, you've got to have a plan, right? If you're going to be paying private money, you have to have the income to be able to service that debt, or an exit strategy, right? How are you going to, maybe it's a development opportunity. You can pay private mortgage rates for 6 months or a year or more, but you need to have an exit plan, right? Otherwise, it's not going to end well for anybody.
Well, that's pretty much it. I think I was looking to find out more about what are lenders' appetites, what are the thresholds that some of the lenders are willing to enter into mortgages with, depending on the credit rating of the who the lender is, or the person borrowing the money. Yeah, just a good sense on what's happening out there from your side of the fence. I'm really looking at a lot of action out there in all areas. Like it's very much an active market. We're into November now, and today's election, I think, is going to get people moving again after the results, no matter what they are. People have to get back to work. People have to pay their bills, and I think it's going to be really good for Canada, being that we're the biggest neighbor that will be able to profit from the outcome that will signal progress for business again. And so I've got people who are expecting that immigration will return when COVID's over, hopefully in the spring, and that's going to be good for the security that the investors need to feel when they're buying and renting out properties. But for now, thanks very much for your time, David. I trust you for anything that requires a good, sound mind on investments, and dealing with you is always a pleasure.
Thank you, Michael. I appreciate the opportunity. It's always nice chatting with you. Have a good day.